What it shows me is that the Fed don't matter.
Holy fucking shit, it's a dinosaur! Jesus Christ, what the fuck? Welcome, ladies and gentlemen, to another issue of the Grey Market Talk on the Tactical Brief with my magnificent guest, Nic Themistocles, market maker, prop trader, bond aficionado, and managing more money than everybody of you ever held in their hands. Nic, did you ever have these 88 billion in your hands, like Duck Mike Scrooge in a special container and jump and bathed in it?
Nobody ever has the real money in their hands. It wasn't 88. One day we're going to have to say what the real number is, but I quite like your beginning, so we'll
absolutely interest people. And then, of course, I have my fellow colleague Tim, right out of the United States. It's 1 o'clock in the morning there, and Tim is one of our quants. He holds a PhD in chemistry. He's built like a Greek statue, very bright, and in his professional time, he invents new polymeric, I wrote that down, semiconducting materials. And I have one question for you, Tim. Why do you keep hanging out with people like us?
Because I need someone better than me to write my dating profile bios. I think you are higher tops now.
Excellent. We get that in right now. So let me start with, just to set the stage here, with my little presentation, which today is only one quite interesting slide. And I'm trying to share my screen, it's always the same. There we go. So, a Grey Market Talk of the 19th of November, 2023. And today we have, as I said, one quite interesting slide to set the stage. Here you can see Mohammed El-Erian, and last week he posted a tweet, or how do you call that now? Is it a tweet or an X?
I think people still say tweet.
Yeah, because I think it sounds stupid if you would say he X'd something. Yeah? So actually, he tweeted something, and I find that interesting because we always look at the rate of change in CPI and break it down. And he has this from the Labor Department, a slide, which simply says the cumulative price changes since January 2021, not that long ago. So we have 21, 22, and now we're at the end of 23. And if you look at this, it actually looks quite shocking. Principal and interest median for home payments over 100% up. Gasoline, 45% up. The CPI is actually the black little line there, and it shows the official figure people are calculating with. When I say people, I mean the Fed and the guys who are making the interest rate policies. Groceries up 20% over this period. How was the average pay rise anybody got there? I made a little survey amongst my friends who still are working, and they on average got an inflation, well, how would you call it? Inflation add-on over these 3 years of roughly 5-6%. That's it, right? So what governments did, or maybe not even governments, but central banks, they actually gave you a huge tax rise, and nobody has noticed it. If anybody would have started an election campaign by saying, hey, mates, by the way, in 3 years' time, your purchasing power will be down on average between 30 and 40%. Do you think they would have won an election? No bloody way. Didn't happen. So, obviously, the topic today is CPI, and another poster for your Tinder profile, Nic. Tim, CPI modeling with Tim. Today, Sunday, 19th, 11th. Why is the CPI so important for us? I switched that off again. For a simple reason. If you're an equity boy like I am, we're looking at corporate earnings. Yeah? If a company makes a lot of money, makes profits, these profits are sustainable and you can forecast in the future, they're worth a lot. The more money they make, the more valuable these companies are. However, this is in the context of a framework, and our context is obviously, what else could you do with your money? What you can do with your money, you can buy bonds, and bonds, the price is directly dependent on the interest rates. Who decides the interest rates? Central banks. Yeah? We don't leave it to the market anymore. Central banks tell us where the price of money will be. So the price discovering mechanism is somehow out of the window anyway, right? The Japanese are doing for years now yield curve control. Nic and I spoke for hours and hours and hours on this podcast about what financial regression they will eventually pull out of the hat to make the sovereign, well, or keep the sovereign solvent. I think that is the right expression for it. So price mechanism out of the window. So we have to work with the tools we see in the market. And what does the Federal Reserve look at? At the CPI. And they have various variations in. How do they call it? It's the super core rate now, Nic, right? It's everything. Yeah, it's everything without food, energy, and shelter. So everything you need to live is not in there. Well, it's great, great measure. Yeah, I don't know how they come up with that, but anyway. So you've seen the video Tim and I had in German on our channel, 1.5 hours about the CPI modeling to go into the details. What can we actually expect when we know the mechanism, how it's calculated, how it most likely will develop against its own past, its own past we have seen, and come up with some clever conclusions. And we want to actually make this online threesome about what are the different scenarios for the economy? And in this context, how would CPI figures most likely develop? Because we've seen it this week or last week. It's amazing. CPI came in a little bit better than expected. And suddenly we saw a 5 standard deviation move in the Russell 2000 to the upside. Yeah. And you look at that and think, really? Finally, yes. Well, we saw it. The alligator jaws have to close. I expected it to from the upside. Yeah, the S&P would take a dive. I didn't see a +5 standard deviation moves in the Russell 2000. Absolutely amazing.
Yes. I mean, just on that, then we also spoke about over the last weeks, why the Russell was struggling. It's because small companies, haven't been locking in or haven't been able to lock in low rates for a long period of time. So therefore, they're more vulnerable to higher interest rates. And the moment the market effectively sees that the Fed are sort of going to have to walk back on some of their rate hikes, then the things that are going to improve are those interest sensitive sectors, especially the small companies, which were extremely oversold, and you're seeing that recover. And the other thing about your 5 standard deviation move, and was it expected, was it not? This CPI is obviously really important, and there was one tweet from one of the hedge fund research outfits, very well known, who basically said, look, we got the CPI wrong. And the consequences of that, were expecting a higher number, expecting the market to be disappointed, expecting sort of the Fed to go on their rampage again, clearly short the market and hurt really badly.
Well, the shorts were massive in the market. I saw an interview yesterday of Dr. Jens Erhard, one of the big German forecasters for the markets. And he went into it and said, again, I like his clarity when explaining stuff. He said, yes, all the indicators that were out there you could observe was everybody was short in this market. That's the only explanation. Then the algos jumped on top of it and we saw this move that happened. However, this is now the question. If we are positioning ourselves, we elaborated on that as well. We are still, if you just look at the official data, in a Goldilocks scenario, right? What's a Goldilocks scenario? Corporate earnings are not crashing. They're doing actually quite fine overall. Inflation is coming down, right? Fantastic scenario. After 2 main basis data points, volatility is coming down on the bond market as well as on the equity markets. Everything seems to be nice. Everything seems to be hunky-dory. And you saw this picture going around. Everybody in the market, I think, saw it. It was a tombstone with, what was it? Higher for longer, 2023 to 2023. So that is actually the segue when I pass the bridge to Tim and say, Tim, can we approach, is it higher for longer or is it not higher for longer?
Well, this is still up for discussion, but it doesn't look like that we are crashing down very fast to 2% from the analysis I did. Another very interesting fact is the CPI numbers that are getting published are always rounded to only 1 decimal, which means if you have 0.45, it rounds down to 0%, right? Which is the number we got. But I had looked into the data. It was actually 0.045. So only like 500ths more, and would have rounded up to 0.1, that the number that was expected, right? So it's like, and this small change was then causing the 5 standard move in the IWM, right? In the Russell 2000.
So it's the announcement like Usain Bolt is running the 100-meter dash in 9 seconds flat.
In under a minute.
No, but didn't he have 9.4 something? His best times or something? If you round it down, then yeah, fine, you're almost there. No, an interesting point. I did not hear about that at any other place. I think Peter Schiff mentioned it briefly in his Doom and Gloom report weekly, which is very entertaining. I love him. Yeah, it's a valid point. People don't see it. That was, I think, the main surprise in this enormous move, yeah, like a coiled spring in the equity markets that suddenly said, yeah, wow, unbelievable. At the same time, Nic, we discussed it the week before, 30-year Treasury auction. People said, nah, I don't want your crap. How do we get these things together? Tim, do you want to take the bridge and put your presentation up and run people through in briefly how the modeling approach actually works to access the future? Because most of them, our followers here on this channel in the Gray Market Talk, mostly speak English. They might not have seen our fantastic 1.5-hour video, which forecasted the future perfectly, even if I say it myself. Nic told me earlier, hey, you got it spot on the last time you did. So,
you were very good.
Hey, it wasn't me. It was the data. It was the data Tim put in front of me. Absolutely. It was just the conclusion of what we've seen on the screen. And let's hope that works this way as well. Yeah, we can see it. You're on.
Perfect. So I think, Thorsten, you have the honor to briefly go through the risk disclaimer.
Oh, yes, today we should put it in, shouldn't we? So, ladies and gentlemen, everything we do today is purely for entertainment and educational purpose. This is not investment advice and shall not construed in any way as investment advice, because that's not what we're doing here. We're just showing our methods, the way we do things, and of course there can be mistakes in it, even if we try to minimize it. So we just advise for everybody, if you're interested in this kind of approach and you have the abilities to try to do it yourself. Yeah, you can do it. Mr. Gates has invented the Microsoft suite Office and Excel in that case, and it gives magnificent opportunities to do so. So if you agree that this is not investment advice, please stay tuned. It's getting exciting. And if you think it would be investment advice, you should switch off now. Everybody happy with my disclaimer?
Sounds good.
Lovely.
Okay, let's start then. So what are you doing today? So at first, I want to give a quick recap about what we did in the last inflation analysis, which was about a year ago. So I will go quickly through the approach that we have everyone on the same page. And then I summarize the conclusions from that video. Then we have a look at the actual development of the CPI value in contrast to our forecasts. And then we follow then with the current forward scenarios that I put on with different scenarios, as we can have a look at the Goldilocks scenario that Thorsten already mentioned. Then also some scenarios where we're probably not yet tight enough to go down to 2%. And I will follow up with some correlation analysis, because we're already already interested how we can better model CPI forecasts. So we will have a look at the new financial conditions Impuls on growth index that the Fed released earlier this year. And then also an extension of the PPI study that we presented in the last video. So to briefly get you all up to speed about how this modeling or the mathematics work behind that. So here we have a chart showing the US consumer price inflation. In this case, from January 2017 to September 2023. You see different bars in this chart. They are plotted over the date. These are always the month for the CPI number, which means January number actually got released to us in February, but it still belongs to January. On the left side, you see the scale for all the bars, doesn't matter if they are blue or gray. In blue bars, you have the actual number of the CPI. In gray, you actually have the 12-month ago, so the last year's month-over-month CPI number. So which means we shifted the whole blue chart by 12 months to the right. We can then also calculate the year-over-year CPI number by actually compounding 12 of the blue bars, which then gives the orange line that you see here. So the orange line is the year-over-year CPI, and the scale to that is on the right side. This we did this approach to actually see how a new CPI number is in competition with the last year's month CPI number, which then shows you if this new number comes lower than the last year month's number, the CPI will drop year over year. So, and based on that, you actually can assess and also can model, when you add different red bars along the line, how the year over year CPI number will develop. And this is the number everybody looks at. Okay, so what did we actually predict or concluded last year? So this chart is showing the same chart like the previous one, but from 2020 with different kind of model scenarios. So we have red scenarios where we end up with high inflation. So these were moving averages that we applied to the existing CPI numbers. We have yellow lines where we applied a constant CPI, like 0.5. We started with the one from the last report, but applied some deceleration to that, like 5% or even 10%. So these are the yellow lines. Then we have a model based on the PPI, 2 lines over here. Based on how we model them, they are shorter because we only got a good fit with a lag of 3 months or 2 months. So these are here in turquoise. So what you see in general is that we predicted a year ago that it takes quite a long time until we actually go that we will see values around 4% or even 3%. And these estimates that we got from this quite naive modeling of the CPI number were much higher, or let's say in this way, we saw that it will take much longer than the market expected. And when Thorsten saw my modeling, I think he concluded, okay, if it takes that long, rates will potentially peak at 5%, and then the Fed pauses and is completely data dependent. And when we now have a look how the actual numbers came in, which is shown in this plot in magenta. So our estimates were actually pretty correct between the best scenarios in green and the medium scenarios in yellow right here. So it took quite a long time until we actually went down to about 3%. And based on these gray bars, we already saw, okay, the August number was 0, so we probably get an uptick back then, and this is exactly what also happened. You can see that at the magenta line, we went up from the 3%, a little bit higher, and are now about like 3.2%.
Maybe I can pipe in here. Why did I actually choose the yellow line as our forecast baseline? It's a simple, well, mathematical or statistical, I don't want to call it trick, but it's a naive approach to it. It's almost like the weather forecast. Yeah? Can I forecast the weather a couple of months into the future accurately? Well, I can say it's winter or it's summer, fine, but I can't really pinpoint the temperature on the scale. On the shorter term, how is the weather going to be tomorrow? Most likely like it was today. And if I'm tomorrow, how will be the weather the next day? Most likely like it was the day before. And this approach assumes not too much of some magic abilities to be clairvoyant or have a crystal ball. It simply says, fine, I look at the data I have available today, and then, of course, I can plug in some variations, but it gives me a relative realistic view without putting too much brain thought in, where I can always be wrong. And that was actually the yellow line we plugged into the model, which gave us, well, a relatively accurate forecast, Tim. Is that correct, or am I making a mistake here?
No, that's pretty accurate, yes.
Yep.
Good. So now we will have a look at some future scenarios from now on. So this is pretty much the same construction of the chart. So we have again our blue month-over-month CPI numbers in bars with the scale to the left. The gray, which are the blue ones shifted by 12 months to the right, that we see the last year, same month's CPI number in comparison to a potential new one. We have our year-over-year CPI number, which got calculated by compounding 12 of the blue bars to this date. And then we have the forecasts in the bars in red, the month-over-month numbers, and in red, the corresponding and calculated line from the year-over-year numbers. So as a quick explanation, these data are coming from the Bureau of Labor Statistics, and I took the raw number. So the raw number allows you to actually calculate the month-over-month CPI from that number. So you are not depending on this one decimal number that you get directly published by the BLS. This is more work, but it also gives you the exact numbers, which is an explanation why I actually told at the beginning that the small change of 500ths was actually enough for rounding effects to round CPI of last month to 0% and not to 0.1 as it was expected. So what I did here for the Goldilocks scenario was I created a random set of month-over-month CPI numbers, which has a mean of 0.1 and this small standard deviation. And it gave me like a random set. And this random set I applied as forecast to the next 12 months. And based on that, you can see the calculation of the red year-over-year line. So in this scenario, we definitely come like pretty linear down towards the 2%. Here, the 2% is about, we will reach it in July, so which means we get it in the August. I guess the Fed will already be very happy getting a number of around 2.5, which is happening around, based on this model, happening around March, April, May. So in this range right here. But this is, again, like a very, very like positive scenario that we see without any kind of inflationary shocks driven by, for example, energy prices, which might always be a risk, especially in the winter season. And also with geopolitical risks that are also like higher than in the past.
Quick question, Tim. For the random data you put in, you simply took it's again a bell curve, I assume. You took the long-term mean and the long-term volatility of the CPI.
Yeah, I actually didn't touch the long-term volatility of CPI because based on the mean that we apply here, it has to be lower. I was pretty much playing around with some standard deviations based on the normal distribution. That is like the basis for getting these random numbers.
All right.
So a second scenario, more or less like a return to normal. So what do I mean by that? So I actually had a look at the years from 1990 to 2019, actually before we got the spike and the influence by the heavy money printing. And I had a look and calculated what is actually the average month-over-month CPI in the whole period of these about 30 years. And the calculation resulted in about 0.2% month-over-month CPI, which annualizes to about 2.4%. So kind of the target that the Fed is actually desiring to see between 2 and 2.5%. And I applied the same logic for getting these random numbers as before. So mean of 0.2, some standard deviation to it, and a random modeling based on the bell curve. And this is again a scenario with like slightly higher inflation numbers in the winter phase. That might be probable if we get a hard winter, some energy price shocks potentially. So what you see based on this scenario is that we will actually stay quite high for much longer than expected. So we are now at 3.2, and based on this model, we dip a little bit, but then raise up again and actually stay elevated above the target of the Fed until like mid of next year or even past mid of next year. So July number we get is in August, and then we dip down more closer to what the Fed is actually desiring to see. So between 2.5 and 2%.
Nic, question for you. If we see this now in this modeling scenario, so we have a higher for longer here, and that would assume that we have real rates of 2%, give or take. Will the American economy sustain that, or will we see things starting to rip apart, especially when we talk about refinancing in the industry?
Well, remember, the two factors that we kind of look at would be liquidity. Is there enough refinancing capacity in the system? And at the moment, that is showing signs that it's continuing to provide liquidity to the system. So therefore, the refinancing shouldn't be an issue. But, the other factors are money supply. So money supply has come down quite sharply and has been turning negative and is now sort of fairly flat, but sort of negative. It's not getting more negative anymore. And that's providing kind of a drag to the economy. And you see that in labor statistics, where for the first time in a long time, in the Jeff Goldilocks test, where we looked at the moving averages of the unemployment rate, and we are just crossing that. So there are some headwinds to the economy as a result of, this is a very special, scenario that we've experienced, post-COVID. Everything is new. And so there are parts of the economy that there are headwinds for. But the good thing is liquidity is up. The bad thing is bank lending is turning negative. Unemployment is starting to tick up. And money supply is sort of continually more and more negative. So there are, pluses and minuses to the overall economy. But when you talk about real rates, so real rates at the moment are, let's just say they're actually over 2%, so let's just say 2.5%. You can imagine that as the Fed sees an inflation handle below 3%, i.e. with a 2% handle, that the necessity for them to have excessive, in their own mind, how they tick, excessive tightening on their side. So you would expect them to bring the real rate down. So let's just say closer to 2 or below 2, 1.5, and that's why tips are a good value. And if that were the case, you look at your chart. The first scenario would imply that by March the Fed will be pivoting, and in this scenario, well, so you can see on your March scenario that was a time where the Fed are likely to pivot, and in the sort of higher scenario, well, again, if looking at real rates, with real rates at 2.5%, if you say that inflation is, say, 2.6, 2.7, let's just say that real rates at 2%, what they're targeting, to 4.6. So again, that's an indication that the Fed would adjust their policy to reflect where they want real rates to be. And that's still about, it's 2.6 or 2.7 March, May. So the forecast for the market right now is for a pivot around March to May. And I think your numbers there, prove that that's actually a good estimate from the market.
Yeah, what you can see here very clearly is that last year's January month-over-month CPI was very high, slightly above 0.5%, which means I think I would assume there might be a little party in February with the release of the CPI.
Yeah, because 0.5 will drop out. The sort of the base effect will improve the market conditions there, and the CPI number that comes out in February. Absolutely right. Yeah. So I think overall, what does this the two charts you've shown so far suggest that the Fed have finished, right? In the two scenarios you've shown, the Fed are basically done.
I don't see, I've just judged by these numbers, I also don't see a reason why they should increase again. And especially, the small businesses, I heard they have to, they are not getting the lending durations as big companies. So they have to refinance more frequently, and they might get like way more trouble if they have to refinance like early next year or like until like mid of next year, because they still have to refinance at higher rates.
Sure. So with the headwinds of the economy that we talked about with the unemployment and the like, with the headwinds of the European economy, which is basically toast, you can expect to kind of bring into your scenarios the likelihood that Fed, ECB, Q1, end of Q1, beginning of Q2, sometime that you'll see a change in policy.
So the market got it right. 5 standard deviations, hooray.
Yeah, I mean,
until earnings come down.
They were far too bearish before, as we spoke about. But yeah, the market is on the way to a new high. So asset prices are on the way up. Liquidity is up, so therefore asset prices will continue to do well. But the economy is facing headwinds, and that's something we can't sort of ignore here. And how that impacts earnings and all of this stuff, we still have to kind of figure out, and analysts have to do their work and forecast. But the economy is Europe and starting in the States to see some headwinds.
Okay, and then to continue with more headwind scenarios, it's actually like what happens if you're not tight enough. So I just slightly increased the month-over-month average of the CPI from 0.2 to 0.25, which gives an annualized rate of about 3%. And based on this mean of 0.25% month over month, I calculated a random set of 12 values again and applied that as forecast to this chart. And you can see here that we are like between 3 and 3.5% for quite a while until we finally reach 3%. So we're not moving down significantly. So, and another scenario, even slightly higher than that. So we go to 0.3% as a monthly average. So yeah, that also increases slightly the trajectory of the year-over-year number between like up to 3.7%. So from the data, without any kind of economic shocks, I don't expect that to happen. Nic, you said earlier you are looking at inflation as a monetary phenomenon, which I agree. You only can have some certain shocks that actually drive prices high, like very, very suddenly. Other than that, if, let's say in this way, everything goes smoothly through the winter and the first quarter next year, I think Fed is done, but probably is still hesitant to cut too early.
Well, pencil prices have to come down, right?
Indeed. No, I mean, these are important sort of factors now to consider. You say, okay, here's my 4 scenarios. Which one has more probability? What is happening? Is it likely to see higher guesses or lower guesses? And then you look and say, well, okay, well, what's happening with money supply right now? Given that the Fed don't look at it, this is a factor that's quite important to monitor. The volume of money in the system is still there, right? I mean, they threw a lot of money in the system. There is still a lot of money in the system, but it's just not growing. And an economy like the States, you need to see growth in money supply around 5% per year, but there is still a lot from the past. That gets used up over time with growth and inflation. But if money supply just ceases to grow because these guys just don't look at it, then obviously that's going to be the negative shock. But on the other hand, if there is an unemployment breakdown and an economy breakdown, then obviously these guys are going to be back on the printing press. Money supply will expand, and then obviously that will provide a floor for inflation.
So Torsten, any final thoughts about the forward scenarios? Otherwise, I will go on and present what I did regarding the correlation analysis.
Now, I totally agree with Nic here. It's if I would have to be forced again to pull the trigger, what are these numbers are telling us? They're simply telling us, yes, higher for longer is a likely scenario, but there is no upside danger in the market at the moment. Yeah, with my perpetual bearishness about the economy, this will kick in eventually, and sooner or later they will open the floodgates, which in the next cycle will again lead to higher inflation, of course. We've seen that. In the meantime, we could have a fantastic party in the markets. And even as a perma bear, if you want to call me that way, I'm seeing that as well. Yeah, this liquidity we see in the market has to go somewhere. It's long duration assets, especially on the equity markets. If interest rates come down, or the market simply calculates with no shock to the upside, that's where you want to be. Obviously well hedged, but you want to be in the long duration assets, which are the typicals. Yeah, we have our consumer discretionary spending. We have our high techy techs, and that could be at least your short-term to intermediate scenario. And seasonalities, obviously it's now a little bit voodoo, bringing in here with all the fantastic real data, also points into the direction of the party is going on a little bit longer until the market has to readjust. That's all.
Yeah, plus I would add some small cap baskets as well.
Yeah, with you.
But other than that, what we have learned from this year is whenever mega caps tank, dip a little bit, just put some of that in your portfolio, right?
Yeah. Obviously, you don't get me to buy Nvidia.
You don't get me to buy Apple either. So we have our pet hates.
Didn't we agree we were waiting for the new headset? And I think they're fucking it up at the moment, because I heard people with glasses like myself. I will not get the headset I want with glasses or medical devices provided by Zeiss, which was the original talk. So this thing, as somebody who can spend $3,000 on a thing like that, I'm not going to do that squashing my old glasses in and trying to do something with it. I want it to perfectly work. So they have to get this thing right to make this a success, because we all have this problem. Yeah, having 5-6 screens on your desk is a little bit of a nightmare. If I could put this thing on and have 4 or 5 virtual screens in front of me, I'm definitely a buyer. So I wait what Apple will provide us. NVIDIA, Magic AI, we're all working with it now, right? Yes, it's very helpful for, I like to say, the basic tasks. The articles I wrote, I did a test with ChatGPT. I uploaded some of my entertaining old articles, and then I've asked ChatGPT to write one according to my style about specific topics. And yeah, they were not bad. I was not happy with it. I thought, nope, it's not getting what I really want to convey there. And they're not humorous. They're still, maybe they will be there one day. But until I see that, I'm more laid back. Plus, I want to see the number of the supporting companies, yeah, the guys who are actually producing the stuff for NVIDIA, show fantastic figures, and they still haven't shown them yet. So it's still a big mystery, question mark, above this market. Anyway.
Good, let's do a little break, and let's go to the CPI Correlation Analysis that I did. First, I had a look at the Financial Conditions Impuls on Growth Index. That's an index that was released by the Fed around June this year, and this is the title of their paper, a new index to measure U.S. financial conditions. So there are financial conditions indices out there already. So what's the difference here? So it also measures if whether financial conditions are tight or loose. But again, they wanted to add an assessment of whether these financial conditions actually pose headwinds or tailwinds to economic activity. So there's an effect on GDP to be modeled here as a target of this index. And they also consider lags as explicit, either more or less effective. So with time, these lags become more important to longer outdated data. So they get reduced weight in their calculation. It's quite complex. They take like the equations are all in the paper. You can read it up. It's officially on the Fed website. So, but what do they actually consider? So they consider the Fed funds rate, the 10-year Treasury rate, mortgage rate, BBB rates, the equity. So they have a look at the Dow Jones here in this case, if I'm not remember wrong, the Zillow housing index and the dollar value. So they do magic number crushing on them and then finally calculate one value out of that. And they actually have a look back value as well. So actually, like I think they have up to 3 values. They have a 1-year look back and a 3-year look back on the baseline index that they put out. In this chart here, published in their paper, you can see the range of existing financial conditions indices in blue. This is like the shaded area, and with where the top side marks the highest value of one of these financial conditions indicators, and the lower part of the blue area, respectively, the lower value of one of those. And you can see that they are in this range, so there's not something fundamentally and like significantly that new to these financial conditions. Impact on growth index from the Fed, but it's like one aggregated value that I considered potentially interesting to see if we can use it as model on the CPI. So long story short, here are some regression plots. I'm not going into detail because this will come in the following section as well, but you can see it looks pretty much like random scattered data. So you don't get any kind of meaningful correlation coefficient out here. So that's why I want to keep the story short. I was not able, by aggregating these values, compounding these values, comparing these, the baseline or the year look back value with the actual CPI numbers or the compounded CPI numbers. So that was a nice experiment, but without any kind of like actionable result.
That's actually quite interesting, because we are talking about financial conditions all the time, right? It's this, what are the banks doing? Is there money coming out? And then you apply the real number crunching to it, and it tells us, well, yeah, sort of, doesn't tell you anything.
Yeah, I would have also, because this index is designed to assess the headwinds or tailwinds to GDP or to economic growth, which you can see by GDP. But in their paper, I haven't seen a correlation study between the FCIG and the actual GDP number. It would be interesting to everyone, right? When you come up with a new index, so you want to actually assess the effect or assess the development of one economic data like the GDP. Actually, I mean, you do a correlation analysis to see how good your index is, right? I've never seen
in the olden days, you would actually have been far, can you call it clever, or is that almost criminal? You come up with a new index, of course, you would apply a proper amount of so-called curve fitting to make your model actually valid before you publish it. Because if you publish it in the shape they're doing it now, and the data are providing, it's like, well, whether you tell people about it or not doesn't really matter. It has no practical purpose in this case.
What it shows just found a way to make it practical.
What it shows me is that the Fed don't matter. Well, I mean, if you think about it, they are adjusting interest rates, hoping to influence the economy. Well, maybe it's the economy that influences the interest rates. And if you look back to, again, Milton Friedman and that, if you look to his papers of interest rate fallacy, the notion of interest rates being low as showing, easy monetary conditions and interest rates being high as showing tight monetary conditions isn't actually, the case, because interest rates being low is because conditions in the economy are very tight. And so they need to get lower in order to stimulate an even lower. And it actually shows that the economic situation isn't strong at that time. So, this is really useful work, but it actually just sort of confirms to me that ignore what the Fed produce and all of their analysis, but it does explain why they're not really influencing the economy.
I should cut that line in the opening trailer for the video, actually, Nic.
Oh, really? Oops.
Yeah, it shows the Fed doesn't matter. So yeah, fine.
All right. Then I've continued, and this is the second half of the CPI correlation analysis, the more longer one, because that actually worked very well. I had a look at the PPI again. So our last video, I was considering the PPI All Commodities Index. So here you see, first of all, you see two regression plots. So the left side is the CPI versus the PPI, in this case, the month-over-month values. So CPI month-over-month over PPI month-over-month. The data was coming from the BLS, so the Bureau of Labor Statistics, and the Fred St. Louis Fed. And on the right side is actually the PPI all commodities number. This is a value that you get only from the Fed. I only found it there. The difference between PPI month over month and which I got from the BLS and the PPI all commodities index is, first of all, the history. So I got this value for the PPI month over month since November 2009. So when I calculate month over month changes, the plot then starts from December 2009. On the other side, the PPI all commodities reaches back until 1913. And the second difference is the PPI month over month is seasonal adjusted. PPI all commodities not seasonal adjusted. On the other side, the CPI month over month, or the CPI raw data is seasonally adjusted as well. So that might explain the slight better fit of the CPI month over month over PPI month over month. When you look at the estimate of the fit, the determination fit of about 0.58 versus 0.52. It's close, but still you can see a slight advantage for the PPI. So when we have a look then and consider different lags, for example, we also want to use it as predicting the CPI. So when you compare same month numbers to kind of predict something, and we have a scenario like last week where the PPI comes after the CPI, I mean, that's not helpful for us, right? So we want to have at least an investigation of a lag of 1 month, maybe 2, maybe 3, and see actually what's the outcome of the regression fit. So this is what is shown here. So this is again the CPI month over the PPI month over month. So for the rest of the talk, I mainly focus on the PPI month over month instead of the PPI all commodities. And here are 4 charts with different lags. So here we have the same chart as before with a lag of 0, then of 1 month, which means I compare last month's PPI month over month versus this month's CPI, or I can then increase the lag. So I take the PPI of 2 months ago versus the current CPI, and the same with a lag of 3 months. All these charts are then biased or based to March 2010, that they all start at the same time and have the same number of data points. And what we see here with increasing lag, actually the fit drops a lot. So that is obviously not helpful for predicting the PPI month over month number from the PPI month over month when we consider lags. So that doesn't work. But what worked, that we have also shown in last year's video, is when we actually compound the numbers to the year-over-year values, which I denoted here as 12-month compounded month-over-month CPI or 12-month compounded month-over-month PPI. So you see here, compared to the last slide, that the fit is much better. So we get values of about 0.89 to 0.91. Best fit was achieved with 1 month lag. So this is this one right here. But all of them are pretty close. So second best fit was achieved for the T-2 plot right down in the bottom left. So when we then actually compare what I did last year, so how much is the gain when we consider these 2 legs versus the PPI all commodities? So this is shown in this chart right here. On the left side, we have the PPI, and on the x-axis, always in as compounded year-over-year number as before, with a lag of 1 month and 2 months. And on the right side, pretty much the same, but with the PPI all commodities index that I used in the last video of last year. So you can see that the gain in fit and the potential better estimate that we get for the CPI is heavily increased from about 0.72, 0.74 to actually like 0.91, 0.9. So that was a very good, significant result and success of this experiment using the PPI. And my best guess is it's the seasonal adjustment that's made to get this improvement. On the other side, what turns out here very well, especially visible for the PPI all commodities, is that we have a cluster down here. We have a cluster at higher values, and then we have these series of data points that is almost like a parallel shifted along the vertical axis, or a shifted trend line into the vertical. So, and I was actually curious, what are these values? Where are they coming from? And just out of curiosity, I just marked the values that were actually published since 2022. So when we actually saw that we have a heavily increased inflation. And these are exactly the numbers that are so far like elevated from the trend line and almost a shift from the trend line. So on the left side, we have the PPI. So I focused on the lag of 1 month, which gave the best fit for the PPI, and the same on the right side for the PPI all commodity plot. And so mathematically, that means that you can see it is almost the same like slope that you could apply here when you visually just shift this trend line. And mathematically means that you increase the intercept. And you could interpret the intercept in this equation as a basis effect that you get on the CPI from the PPI. Because no matter what the next number will be, you always have this as additive to the value. And this was kind of when I raised, or when the question raised in my mind, is this an indication for a systemic persistence of inflation that we have still in the system? So yeah, that's probably the most interesting chart from the whole analysis.
We discussed it last week. My question was, could that mean to both of you a secular change? That the long period of falling inflation or falling producer prices is over, because the data indicates us, yes, we have this base effect kicking in now. Whatever happens in the future, there will be an add-on to the numbers we are seeing, which will fly in the face of what we discussed earlier, to say, yeah, fine, it's over. Huh?
Well, my sort of thing on this is something that we talked about a while ago in our discussions about the behavior of companies and how quick they are to increase prices to the consumer. I think the blue dots without the circles show that there was a lot of absorption, or the slope is basically the absorption, I guess, of the price increases by the companies and not passing on to the consumer. But if the curve shifts up, isn't that just saying that the industry are now quicker to pass on price increases, and therefore, to some extent, when people accept that there is inflation, everyone joins in and says, well, okay, now I'm just going to put my prices up proportionately more for when I sell it to the consumer than I did before, because now everybody's kind of realizes their inflation, so therefore I can just sort of add a little bit more to my prices. And I wonder, whether that's going on here. I mean, as governments analyze whether or not there's been some profiteering, I think your chart effectively shows that possibly there is. Or am I sort of misunderstanding the dots?
I think that's that's a brilliant take. With my equity hat on, I immediately would think, so yeah, what company would I buy in a scenario like this? It's the Microsofts of this world, yeah, who can pass on price increases just as they please, because you're not switching off your Excel just because they checked up the prices by 10-15%. What we've seen now at the moment with my Apple TV subscription, Netflix subscription, I think Spotify as well. Yeah, they're just slapping 10, 15, 20% on. Also insurance companies, you all got your bills by the end of the year now. Car insurance, I have 2 teenagers which are insured in a car. They just checked it up by 20% across the board. All companies out there, you can't find competition. That would reflect what you just said, Nic.
I mean, that's quite possible. We kind of hinted on this some weeks in the past when we discussed it originally. But, I think what this analysis shows brilliantly, actually, is there's a strong possibility that that's actually what's going on.
And when we consider, again, the falling year-over-year CPI inflation number that we got, it actually indicates, okay, what you said, Nic, companies are way faster to increase the prices for the consumer. But also what I see here is, with regard to the falling year-over-year CPI numbers, that are also slower in actually releasing the pressure on the consumer, right?
Yeah.
And the question is still like, where is this this push to have the higher consumer prices actually coming from? Is it still like wage inflation? Is it still like that just refinancing is actually way more expensive at the moment, so they have to finance them somehow, and the easiest way is just having price increases on the consumer, as long as the consumer can still pay for them.
That's probably why the Fed is focusing on pencil prices.
Well, in a way, yeah, I guess, right? And also why governments are calling in all of industry, and industry is saying, oh no, we're just sort of passing on. And of course they're passing it on, but they're passing it on much more than they used to in history. In history, you can see that they've been absorbing some, which is really good, what they've done in the past. But going forward, it looks as though something different going on. It's a different behavior pattern.
History is exactly the right word, because I was interested, hey, is this because the data is since February 2011? So how does it look in the historic context, right? And for the historic context, as explained earlier, we cannot use the PPI month over month. We have to go with the PPI All Commodities Index, because they give us a much longer duration in the past. So actually the limiting factor then is the CPI. The CPI number is available until around 1947. So month over annualized numbers are then starting at 1948 that I calculated. So, and this is shown here on the next slide. So we have the current one that I had on the right, just in the last slide on the top left, starting from 2011. Mm-hmm. Then I have a plot to the right from 1990, then down here in 1980, and then here the longest history in 1948, as I just explained. And what you can see here is, yes, we had times in the past where we also got data points in this regime. For example, here, when you look at the plot from 1990, you see some blue dots which are not circled, but appearing the same level. We have other more crazy and more higher inflation history data points shown here. This definitely should come from the 80s. And yeah, this is the longest one. So you can still see the red circles are definitely above the trend lines that you can see here, but it's not so, I mean, it's not unique in history perspective, what these plots show us. But still significant. So it will be interesting where the next red circles will move. Will we go faster down towards the trend line? Or, yeah. That's
interpretation then could be for the future to say when our red dots are approaching the long-term average or the regression line you have here, you could say, fine, what we're experiencing here at the moment, if we are moving closer again down to the regression line, that might be a shift in regime again. At the moment, we have the higher for longer, yeah, or the non-absorption of production costs, passing it on to the consumer. When we see the first data points going down again, that could be again a shift to a long-term average again.
You know, my sort of feeling here is that what's going to happen is that this 1948 curve is going to be, you know, the path for the current curve. In other words, when input prices start to fall, obviously nobody's going to cut their prices, so they will keep their prices higher. And it shows me that there's margin in corporates. That's why sort of corporates are, you know, have performed far better than what the market actually expected. There's clearly room for them to absorb some wage increases. Maybe that, you know, not a great deal. But if you were a government, right, and you saw this chart, this top left chart, you'd basically say, right, and we talked about it also before, that the growth in earnings so the growth in earnings that we're seeing is post-tax. So, you know, where is it likely that the governments are going to bridge the gap from their sort of huge debt pile? It could well come from, you know, squeezing the corporates a little bit more by increasing corporate taxes, because, you know, they've clearly taken advantage, you know, during this time to actually raise their prices. And as inflation falls, you know, those prices ain't going down. I mean, they will stay up there.
So we can just hope that Tim's charts are not filtering through to Congress.
I mean, it's fair. I'm sure someone's done this analysis, but I think this is, spectacularly shown here in this chart, what's been going on.
Okay, and then my next question was actually the analysis I did with the regression. I was applying that over the whole data points, right? But I was interested, does this approach of doing a simple linear regression of the CPI based on the PPI number, does it have statistic meaning if we actually lower the number of data points to the actually observation period? And for this analysis, I have 3 new plots here again for the full data, just to explain the charts, what I mean, because you will see them in the future a little bit more. On the left side is standard simple linear regression plot with confidence intervals that just shows you based on the fit and the correlation coefficient how good the fit is. This is the main part I've been looking at in the future, on the future slides. Then in the middle chart shows you the investigation of the residuals, which means if you have a fit on the left side, all the errors that you see between the actually blue points and the trend line or regression line, all these errors here, all these deltas, if you plot them and investigate them for normal distribution, you should see them all stacking up on this like line in one line with a slope of about 1 and an intercept of 0. And you get, again, an estimate for the quality of the fit by R squared in here, which should be around 1. Then it's good. Even though they can be randomly or like, so this is pretty much a test if there's no systematic error in your regression. But even if they kind of align, there can be cases, especially when the data points are only a few, where you can still get or can model an addition to that. Or can you explain the errors? And this is shown on the right side. On the right side, you see these errors, so all these deltas plotted against the actually X value. And if you get a good fit here I applied always a 3-degree polynomial for the regression. If you see a high R square value here, that means you actually like there is some additional effect that you should consider in your modeling. So your normal linear fit that you applied on the left is actually not enough. So, but here everything looks like it should look all great in this example. But as I said, this is from March 2010, so we have a look at all the data points right here.
So as an equity option, boys, that means stuff forecasting markets, bell curves everywhere, yeah?
Yeah, based on lack of broader knowledge of what other kind of distributions should maybe considered. So yeah, then it was pretty much to decide on the window of, so I have here all data points from March 2010 to now. So now I'm only considering 12, which means I'm looking at data points for 1 year as a window, and then I shift these. So we started March 2010 to February 2011. This is one set. The next set, when I shift this window by 1 month, takes the data points from April 2010 to March 2011. And I continue shifting this window and doing this analysis that you see here until I've reached the current date. So, and I did this for different window sizes. So I started with 12. Then I went to 18, 24, which means 2 years, 3 years, 4 years, and finally 5 years. And then I summarized it all in a table, which you see in the next slide. So I'm pretty sure I lost all of you right now. But the main message here is when we do this rolling window size analysis, and we have a look at the different lags, which are also considered, which was the lag for the PPI for modeling the CPI. So which month do I take to actually look at the current CPI? Is it the actual value of the same month, or 1 month ago, 2 months ago, 3 months ago? And then I did this window analysis. And you can see here all is colored red because I actually never got a correlation coefficient of around 0.85 or 0.9, which actually like where value for the correlation coefficient starts, that makes it interesting. So, but this was actually kind of expected because we were only using the PPI month over month here. So not the compounded one. For the compounded one, this is a plot that I showed earlier. So this shows the compounded CPI for modeling the compounded CPI, so CPI over PPI as before, and the same three charts as I explained before. And then I was also applying the same windows. And so this is how then such a window chart looks like. So here are all the different, starting from February 2011 with a window size of 12 months. So this is from February 2011 to January 2012. These 12 data points. With these 12 data points, I calculated the slope. So I did this regression right here. Took the slope, took the intercept, and took the R square from this data set of these 12 points. This is the first data point right here of this blue line. And then I had a look of the QQ plot, which is the middle one called here. Took again R square for the QQ plot and R square for the residuals over X. This should be close to down 0, right down here. Then I'm happy with it. The other one for the QQ plot should be high up there because of based on the reasons I explained a little bit earlier. Oh, and then I shifted this window. So this is how I got all these data points that you then see here in one line. So starting from February 2011, and then shifting this window month by month, and then I got all these values that are drawn here as a line. And I did this again for different window sizes and different lags, and the result is summarized in this table right here. So again, here are the lags, which I explained earlier, what they mean. You have my different window sizes of 12 months up to 120 months, so which is 10 years. So this value here should be very close to the values I get for the whole data set. And then I have, for each of these categories, I have the slope with the mean and standard deviation. And oh, by the way, one thing I forgot to mention, the red line right here, this is the expanding mean over the data set. So it calculates with every new data point, it calculates a new value for the mean. And this is then exactly the values that you see here, plus the standard deviation, which is not shown in the previous plot. And for the longest window that I applied here of 120 months, so 10 years, you should get very close to the values that you saw in the initial data plot, where I actually considered all the months. So which was the very first plots I showed with all the blue data points. And so it's actually colorized what was significant to me. Significant to me is always when you get a correlation coefficient of around 0.85 or 0.9. So as high as possible, but these are numbers where it actually like makes sense kind of considering that. So better 0.9, but I started here at 0.85. And you can see here, the conclusion earlier was actually the lack of T-1 works the best. But when you do this rolling analysis, you see that actually T-0 is slightly better. But as I explained earlier, you cannot actually apply T-0 for any kind of forecasting because you might get it actually like after the CPI as we had it last week. So, but another main conclusion is this analysis actually works statistically tested through rolling the window, through defining a window size, so not taking all data points and then rolling it 1 month forward each time and aggregating all the values for the slope, intercept, and the R squares and correlation coefficient. So that was the main test that I did here, and I'm very happy with the result. So it has definitely statistical meaning. It's not just an outlier that we actually got based on actually considering all the data points. So, and then finally, these are how plots for T-0 look, and also as forecasting T-1. And here's something that I want to point your eyes on. When you look at the intercept, we discussed that the intercept is actually could be considered as a base effect. And again, what we see here, these are the window analysis or these rolling regression plots for window of 12 months, 36 months, and 60 months. With the for each of these window, like here 12 data points, 36 or 60 data points, and then always rolled over or shifted by 1 month, considering the next 60 data points. And what you see here when we only look at the intercept is you actually see this basis effect. So this was during so this was the high uptick that we saw, and then we are coming down. We are not so this is the fastest one because it's a 12-month. So we're not going down much further based on this data. So it is an indication it might take longer until we really come down to what we saw earlier as this trend line, where we had the red circled blue points way above, almost like parallel shifted along the vertical. So this is an indication how you could see this from this rolling analysis, actually, in my opinion.
We discussed that the intercept. Point again to the first line, where we've seen the peak over there. Tim and I looked last week into the data, and I thought, okay, fine. If I look at this 12-month rolling average I have in there for the intercept, it already tells me that the base effect is actually shrinking. But if I take longer rolling data into consideration, we're not quite there yet. What does that actually mean for the markets? Yes, it is still higher for longer. Is that the correct assumption we see here? We've seen the peak, but if I go into longer lasting data, it does not give me yet the relief to say, okay, that's it, we've seen it, we're coming back. If you remember the slides we had earlier, that the parallel shift is still in effect. It's working. Yeah. We have the shift to the upside. That is the intercept we have seen here. And yes, even though we have peaked, it's not quite the time to calling off the dogs yet.
I mean, what you can see here is that from the PPI alone, the pressure on the consumer is still elevated.
Yep.
That companies are not like, putting their finger off the consumer because they actually need to get their margin, right? And they can't really, or they have other costs that they need to compensate.
So in the data, we can actually see the reason why the equity market is still performing so well. The companies are passing it on, and they keep on passing it on. That's why their corporate earnings are still intact. And even though there will be no elevated pressure to the upside, a very quick and dirty assumption could be, if we don't see a change in this data, corporates will be able to pass on their earnings. There will be, as I started the conversation, there will be no pressure on earnings yet if the economy doesn't go into a tailspin. If we really have a Goldilocks scenario, they'll keep on making money nicely.
I think the biggest question is, when will the consumer run out of cash?
Yes. Well, we did that last week, Nic, right? They have another 400 billion they can blow away until April.
Yeah, absolutely. There's still money in the system, and I think that's so even though you got that moving average of the unemployment rate through this, was it 40 or 45 week or month moving average, even though we are at that level.
Nic's breaking down.
Level where theoretically think what money they've got in their pockets, consumers still rich. And in addition, they the pace that they're spending, you would expect, if the unemployment rate is starting to go up, that the consumer will be slowing down the spending. They're not, which means that they're not worried about necessarily losing their job. Maybe they feel that the economy is still robust, and they, if they lose their job, they'll find a job.
Or if you're evil, you could say they simply spend everything they have available because you can't reduce it anymore. That's it. Yeah, the last hooray.
Or they know that there's another check coming.
Or that.
Okay. Last slide. Then we are done with the math and with the plots. So I tried to get an estimate, to put my head out. Let's see if I get slaughtered or not. For an estimate for the November number that we will get next month. So there are different ways how I can get this. So either I take the regression that you see here at the top for the T-1 and T-2, compounded month-over-month CPI over compounded month-over-month PPI, and crunch numbers, get my estimate for the year-over-year CPI, and then knowing the 11 values before that, I can calculate the 12th value, which will be the one here, the month-over-month. So since we got a PPI, which was like, it was collapsing, right? It was like minus 0.4, if I'm remember correctly. A huge surprise to everyone, or minus 0.5, so minus 0.5, I think even. Big surprise to everyone. Big surprise with contrast to the expected value and even to the previous month value. So that's why, I mean, this is not realistic. I mean, I don't think that's realistic. We would have to see like completely collapse in the remaining 2 weeks of November. We also know that we had a data series that is actually like shifted to the upside, like a parallel shift of the trend line. If I consider that and I adjust the intercept based on these data series that we got lately, I calculated the mid 2 rows, and I did this for the T-1 on the left, T-2 on the right, and then I averaged, because to make my estimate hopefully a little bit better. You can still consider that as range. It's still a big difference. I think now we are at 3.23. So falling down to 2.7 would be a huge surprise to me. And what I then also did, I actually used only the data points that I previously circled in red, did a linear regression only on those, and then calculate these values. They give the highest values because they accurately consider the shift in the intercept. It's not like a qualitative adjustment that I did earlier here in the second row, but it's the accurate adjustment for the intercept and also the slope. So that's why you get higher values in this case. And then when I again average over all of these three values, I get this estimate. So about 2.9 and a month-over-month of slightly minus 0.1. I still don't like that we go negative because I think this is quite rare. But so if we land about 2.9, 3%, so we get probably like minus 0.1 or 0, this would be my best guess based on the data and the calculations I did.
But the most accurate assumption is in the third line, right? Where we just use the data, the new regression, the parallel shifted showed us, which would indicate a month-on-month increase of 0.62.
Yeah.
The number below is the average of the also, well, let's call them not the most likely cases. So the battle would be the aggregated number minus 0.12 in the November numbers, but just taking the recent past into consideration, we would actually see an increase.
Yeah, you only have to think that this regression only considers the effects that we saw since January 2022.
Yep.
So where we still like pushed a lot of money into the system. So this actually doesn't consider that we might fall back to the trend line. So that's all from my side. I think I tortured you enough with like math and plots and.
No, I think what we're going to do anyway, I'm going to upload that to our website, also the presentation, that people can have a look into the data. I think that was a brilliant analysis, and everybody who stuck with us for this time actually knows that they're not just pulled out of a hat. They are they're based on realistic assumptions in the economy and the modeling process. Everybody should have in place to, well, give us a brief forecast or a reasonable forecast into the future, especially if you know what we're doing. And if somebody wants to work that through, and I know a couple of guys who are actually quite keen on getting their hands on these slides to follow through with it, it can give us, I think, a very, very good indication about the, how do you call it, the probability cloud, yeah? Is the cat dead or is it not dead? We have that now here in the box to make realistic assumptions. If the data then comes in as the forecasts indicate, I think the roadmap is quite clear ahead of us. If it's not coming in as the forecasts say, then it's time to look again and say what was wrong in the base assumptions we had in here. And then we're going into, well, into the big macro picture again. But Tim, I can't thank you enough for that. I think it's absolutely brilliant. It worked 12 months ago. Let's see whether this will give us a shorter look into the window the future provides us. And as I said, I put it on the website. Everybody can have a look into it, and there will be definitely more to come, because with the tool you've developed here, we can run all sorts of analysis of different data sets. If you switch your screen off, I'll make a little wrap up of my main points I had in here. So first of all, financial conditions, useless. doesn't tell us anything, right? Nic said the Fed is unimportant. It shows. So yeah, we see
only when they look at silly data, in my view. So.
We've seen a longer view, the historic data above all commodities, and we've seen a shift to the upside, which means the intercept or the add-on is higher as we perceived it in the past. That could lead or could give me the idea that we actually have seen a secular shift in the market, yeah? And that has implication for the corporates. Or what the corporates are doing at the moment, an explanation why earnings are still good, because they have the pricing power, they pass it on. My Microsoft example I had in there. And thirdly, where we started the whole journey, that yes, we are higher for longer, doesn't seem to be really dead, but the risk for an upside shock is very, very limited, what we can see here, especially taking into consideration that there might be a recession or, as I call it, a major depression be ahead, especially with Europe being completely screwed over. America can't escape from that. And then we have to look into fiscal policy again. What are the guys doing to finance their debt scenario? And that's the overriding factor where we can say, okay, price discovery mechanism, yeah, not whatever. The big players in the market are the politicians who are making this. And I like the line Nic put in. If they look at the charts, they see, oh, where can I get some more money, please? I can take it off the corporates, because they are coining it at the moment, because they're passing more prices or higher prices on than the PPI actually justifies. And that's what we've seen in the data. Did I sum that up wrong, or did I get it right, Tim?
No, it sounds like the right conclusion, especially the last sentence that you said.
See, I've already forgotten that. I say so many intelligent things.
That's why it's called the grey market talk.
Exactly. It's like, what did I just say? It must be early onset Alzheimer. Well, not that early anymore. No, gentlemen, I think that was a fantastic show. Obviously, we were aiming more into the direction of the institutional investor here. The environment Nic and I are coming from, and Tim is showing us the odd trick how combining market experience from a trading side and from an investment side actually always has to be put into context what the data tells us, and analyzing the data in a proper way is the thing that actually makes fun. What I'm always teaching is know what you're doing. Go in with assumptions. The assumptions can always be wrong, but at least you have a plan in front of you. No plan really survives the first contact, but it gives you an indication what you might be able to do. So on that sense, I'll pass on, give the penultimate last word to Nic. Nic, any penultimate last words?
I think that was a fantastic analysis, and would love to see Tim extend the analysis to money supply and its relationship with CPI. See if there's any real forecasting possibilities there. But a great job.
And Tim, you put in all the work. Last words?
Oh, and I mean, picking up on just Nic said, I will be also happy to see in the comments some other suggestions. I'm happy to include suggestions from our viewers as well for actually kind of the modeling of the CPI. So especially I'm curious what will happen when I check this against the money supply, since the FCIG was so significantly falling. So very, very curious how other financial conditions parameters will result.
Excellent. Thank you very much. Then I will say, if you like what you've seen today and you haven't subscribed yet, subscribe, share it with your professional colleagues, share it with all interested investors. I learned a lot today. It was amazing. Thank you very much, Nic. Thank you very much, Tim. And I hope I see you soon on our channel. Bye-bye.
See you. Bye-bye.
Bye-bye. Thank you, Thorsten. Thank you, Nic.
Thank you.